Welcome back to the Industry Leader Update. As you've noticed, we're not in our studios, but we will be returning shortly. This week, I'm going to bring you a news roundup of the stories I believe that have the most impact and relevance to you as a reverse mortgage originator and professional. Again, be sure to go to HECMWorld.com any day of the week. You can get our top news stories, our commentary and analysis, and of course, our top 100 HECM lenders report. Let's go into our first story. It appears that the Australians are where we were here in the United States with a reverse mortgage back in 2009, 10, and 11. In fact, Australians are flocking to reverse mortgages and tapping into their home's equity. Just 768 individuals had used the pension loan scheme, which again is a form of a reverse mortgage down under by the end of the 2018-19 fiscal year. But their number swelled to 4,039 by the end of March this year. So the pension loan scheme allows one who has reached pension age to increase their income when their family home or estate is put up as collateral, and when the house is sold, the loan is repaid. So basically works the same way as ours in the mechanics of the loan. And one of the things that may really change this is the availability of a lump sum. In fact, the Actuarial Studies Unit at the University of South Wales expects access to lump sum payments will increase the attractiveness of the pension loan scheme because many want to make a large purchase. The pension loan scheme in Australia does have a tier system, which is quite interesting. The maximum that can be received is 150% of the full age pension, and it's not only open to full pensioners, but also part pensioners or those who are self-funded. In fact, the self-funded retiree, the maximum they can get is about 1.5 times the full age pension. And speaking of consumer interest in the reverse mortgage, let's look to us here in the United States. Reverse Mortgage Daily had an interesting article last Monday, more specifically the quotes from Reverse Market Insight as to some of the concerns about refinance volume. When we looked at the case number assignments from FHA Single Family Production Report, it shows that FHA case numbers, 45% of them were a refinance of an existing reverse mortgage. One of the more interesting observations in the RMD article is the specific regions of the U.S. that are seeing a growth in HECM activity. The Great Plains, in fact, increased 22.7%, followed by New England at 15.5%. And part of the reason that the growth is restricted to those regions could be due to the general HECM to HECM refinance activity, that according to RMI's president, John Lundy. Given the preponderance of H2H refi activity we've been seeing, it looks to me as though the industry could be testing the limits of loans available to be refinanced in some of the historically higher volume areas. And what would those historically higher volume areas be? Well, it could be regions such as the Southwest. That would include California and Nevada, and also the Northwest and Washington and the coastal cities where we're seeing just incredible home value increases. And of course, we're seeing a great uptick nationwide. Let's look at some cities that we should be mindful of as reverse mortgage professionals. These are the cities that have the largest percentage of homeowners who are in danger of foreclosure. This from MarketWatch on July 7th. And there's a group of homeowners who are behind on their payments. Around 14.7% of the 7.6 million FHA mortgages that are outstanding today were delinquent as of May, and that was actually an increase from April. Additionally, 10.5% of those loans were seriously delinquent, meaning they're 90 days or more overdue and in danger of going into default. And we're seeing the forbearance periods wind down when it comes to overdue mortgages or mortgages that are in default. And these are the cities that are threatened by a scenario of high percentage of loans in delinquency. You have Atlanta, Sandy Springs, Alpharetta, Georgia, followed by Houston. We have Chicago, Dallas, Washington, Arlington, Alexandria, D.C., Baltimore, Riverside, San Bernardino in California, Texas, San Antonio, Fort Worth, Arlington, Grapevine, Texas, and Philadelphia. So if you're working in any of these markets, you could see an additional inventory open up, and that could adjust the housing market prices a little bit. As we know, demand is insanely high. That has been driving the prices. In fact, the housing shortage or a lack of inventory, this could open up some of that inventory in these specific markets. Well, that's a wrap for us on this informal edition of the Industry Leader Update, giving you a news roundup, some of the news maybe that you don't see reported elsewhere. We'd like to bring that to you so you can be best informed in how to proceed in your marketing, in your business practices. Please share this video with others on Facebook, LinkedIn, and Twitter. We always appreciate your help in that. And if you're on YouTube, subscribe to our channel and hit the notification bell. That way you never miss an upcoming episode. That's a wrap for us this week. Thanks again for joining us, and we'll see you soon for more reverse mortgage news, commentary, and analysis here at HECMWorld.